For the past 2 years, you've been with me on an exciting property journey, and along the way, we have discussed renovations, finishes, a few nice things. But there is a question that has been coming up, sliding into the DMs a little more often. Well, the answer is simpler than you may think. At this juncture, it's a combination of cash and equity, specifically mortgage refinancing and home equity loans. These are tools that I've taken advantage of. They've been beneficial to me, and it's a great time for us to discuss them with the team at Republic Bank because they may be tools that work well for you. I'm Kelly Johnley, and this is Bajan Renovation. I always say, guys, that the beginning is a great place to start. When people hear mortgage refinancing or home equity loans, there's always a little bit of confusion. We're not sure what they are, we're not sure how they work, how they're supposed to work. But at the basis of both is equity. Tell me, what is equity in a property context?
Well, basically, equity is the portion of the home that you own.
Okay.
So it is basically the difference between what the property is valued at and what your mortgage balance is. So in layman terms, if your property is valued for $500,000 and you owe the bank $200,000, then the equity in the property is $300,000. So that's basically what.
Roughly, that's how it is.
Yeah.
Okay, how? I mean, you said it, but I need you to talk to me like I am 5, right? How do I find out how much equity I have in my property? What do I need to do to find that out?
Well, you can engage a professional valuer to value the property, and they would come to the site, they would look at the property, and they would give you the market value, the current market value of the property. And that's how you would know what equity you would have.
And is this valuation something that the bank requires? So let's say I'm coming to you to have a conversation either about a home, refinancing, a loan. You need this information, you need the equity to be confirmed by a valuer, or we going on vibes?
No, you ain't going on vibes. Depending on what you want to do, yes, we need to have that professional valuation so that we understand the numbers that we are working with.
So you hear that, guys? To get the ball rolling, we're going to need a current valuation. Now, I know some people have valuations done on their property from time to time for insurance purposes. If I have a valuation, is there a period in time in which the valuation, I guess you could say, is valid? If I had one already, I got one done 2 years ago, is that valuation a current valuation for something like this? What's the timeline or window on a valuation for you guys?
3 years.
3 years?
3 years, yes.
Okay. Listen, I'm about to come back for more. You shouldn't have told me so. I got current valuations. Is there a way or how does a homeowner build equity in a property? Is it a case of something that I'm doing? Is it the passing of time, conditions of the market? What drives it?
Well, a few factors can impact your value of the property. Let's start there.
Okay.
Right? Because again, the equity is what you may owe on the property against what the true value on the market is, right? So if there's maybe a development close by or enhancements done in the neighborhood or surrounding areas, then that may impact the value of your property as well.
Okay.
Other thing could be maybe over time you may have made improvements to your property, did something for pocket to improve the kitchen, the bathroom. Those type of stuff improve the value of your property. So that's really how your property value goes up, is increased.
And I guess too, just the combination also of over time you are paying down on the balance.
Correct.
Okay, I think we have a good foundation, and you also told us how we can find out by getting the valuation. Now, home equity loans, mortgage refinancing, similar but not the same. Please tell me what they are.
So a home equity loan basically is a separate product So when we look at the equity that you may have, we would give you what we call a home equity loan for whatever reason, and that would run alongside the mortgage that you currently have. So you would still have the mortgage facility, and then you would also have a home equity, which would be a new facility that's going to be opened, running with the same terms as the mortgage.
Okay, let me deconstruct that a bit. So you say it's a separate product. So I just want to make sure you all are clear. Your mortgage does not change. So if I have a mortgage for $2,000 a month and I am accessing the equity in my property, the home equity loan is a separate loan. So I have a mortgage and I have a home equity loan.
Correct.
And the terms of the home equity loan, i.e. the interest rate specifically, and I believe the duration of the home equity loan are the same as the mortgage?
Yes. So the home equity would run alongside the mortgage. So if the mortgage has 15 years remaining, then the home equity can have the 15 years remaining.
Okay. Yeah. All right, so guys, just one of the reasons why I found that attractive is this. Usually coming into Christmas, there's usually a proliferation of loan facilities on the market. My personal favorite is the very high unsecured one, the $60,000 one. Nobody gets their papers together faster than me. But one thing that I have learned over time, particularly depending on what you want to use the money for, is that unsecured debt is expensive. You can get it fast, but it's expensive. I found that by using a home equity loan, the payments are a lot lower. So for like $60,000, I think that you may pay as much as $1,500 a month. I think it's somewhere around there. But if you have a $60,000 home equity loan, and again, guys, this is very subjective. This is based on figures that I know for my property. You can go find out for yours. You may only be paying maybe $500. You may be paying $300 more. So the money is cheaper over time in terms of the impact it may have on the day-to-day. Am I telling the truth here?
Yeah, you are.
You see, I did this. So that is an option. So when I get a home equity loan, so let's say this loan, I was able to access of the $200,000 in equity in my property, I accessed a home equity loan for $70,000. Is there a restriction on what I use that money for? That's a question I've been getting. I know I used mine for property, but can I use it for my child's education? Can I use it to buy a car? What can I? You can tell me what to use this money for, or I can decide?
No, you can decide. I mean, yes, we call it home equity because it's based on the home, but you can use it for anything. You can use it for travel, for education. You can purchase a new car. You can do anything with the money. It's not restricted at all.
Okay, so the term home equity loan is really to show that what is securing the loan is the equity in the property. Yes. Once you get the money, right, you can determine what that money is for.
Correct. Because remember when we would have given the facility initially, we would have secured the property at a certain amount.
Yes.
So for example, if the house was for $500,000, then we would have security in place for $500,000. Right. And you've paid down over the years and your balance is now $400,000. So you have $100,000 in equity. Right. So we would use that home equity loan because we already have the security in place. And we wouldn't need to do any other legal work. Right.
For all of you who have hot up my phone asking me what you can use a home equity loan for, I have chosen to use it over the years for property, and that may create the confusion that if you get the home equity loan, you have to use it for something with the home. You don't have to. It is a completely separate loan from your mortgage. You can determine where those funds go. I know a lot of you are thinking about doing renovations, but also sending kids off to university. This is a viable option for you. Now, mortgage refinancing. I found this was loads of fun, and of the two, it is my personal favorite because in terms of moving the needle financially for me, this made a big difference. Dario, what is mortgage refinancing?
Right, so look at it from this perspective. You may have borrowed a particular amount in the past. Just an example, $400,000. You've paid down. your balance may be now 200,000.
Yes.
You may want to go back to that 400,000. So you can do that, right? We already have the coverage in terms of security. If it is though that you need to get additional funds, then there's something called upstamping. That's, we're going back to the legal process now to cover that additional amount of money that you need. So in that refinancing aspect, you are now eligible to get what our current terms are. It could be a new rate, a new tenure, and at the same time, it may even, bring that current payment down a little for you.
So I'm glad you said that, because that is what happened for me. I had come into the bank to secure a mortgage, and at the time I wasn't asking about mortgage refinancing, and when it was proposed I was like, but this sounds complicated. And okay guys, I can tell you it has some steps, but it was worth it. So just for context and for the conversation, when I came to the bank, I already had 2 mortgages for properties in the villages at Coverley, which I had not only been paying on for a number of years, I was paying ahead. So the bank had said, look, if you have current valuations for these properties, get back to the valuation, they will ask for it. So just accept that you're going to get it. And yes, you have to pay for it. They said, if you have current valuations, let us see what the values of the properties are and what is owed. And they said, well, look, you have built up equity in both of these properties. Here is what may give you not just some financial ease, but an opportunity to do more with your money. If we take over the mortgages and consolidate them, which is what they did, before I would have had mortgage payments, 2 separate mortgage payments that may have been, let's say, in the vicinity of, let's say, $4,800. That was when Coverley was cheap. Best of luck to all of you now. It was about $4,800. When they refinanced it, the mortgage on the 2 of those came down to about $2,000. And that is issuing what the bank would call a separate mortgage. Almost like the mortgage refinancing ends the current mortgage you have and then reissues it based on the balance that you currently have on the new terms. That was a game changer, because all of a sudden now we got more money to play with. As you all know, Kelly spent all. So you told us what mortgage refinancing is. You told us what home equity loans are. What is best for who, when and why? How do you determine what works for who?
But that's a really good question, Kelly, because it depends on the customer. Everybody is different, and we wouldn't really know the case until we actually have that conversation. So it's best for the customer to visit the branch or call or email and just start that initial conversation, because we have to look at the picture, the holistic picture, to understand which one will best fit the particular person who's in front of us at the time.
Got you. Something that I guess you could say was surprised by questions that I got, but I think I'll say, guys, this is not free money, right? Particularly when it comes to the home equity loan. I think sometimes I just want to make a clear distinction that this is a separate loan. And even though it is secured by the property, the bank still assesses your ability to repay the separate loan. Because one of the questions I got last night was someone asking, they said, okay, I know that I have this property and it's valued at, so I can get this from the bank. I said, all things being equal, in theory, yes. But you guys still do an assessment, as you say, for the bigger picture. You could expand on that a bit for me?
Yeah, sure. So the customer would normally bring in the regular stuff that we would need them to submit, job letter, pay slip. We look at their credit score, credit report, any financial obligations they might have outside of Republic Bank. And then we do a full assessment and we base it on that.
Okay, so you are looking at my ability to not just only pay the mortgage, which I have been paying, but to pay the loan.
Correct.
Good. So for the mortgage refinance, I know already that gives you a little bit more room in the pocket, right? And it is giving you get to get a little more cash flow. However, it is, as I call it, it's almost like selling the loan back to the bank, for want of a better word. You mentioned upstamping. Is there a legal process for a mortgage refinance, or I send you a few emails and you let me know that this is how we're going. What else happens after we establish that, look, you're in a good position for a mortgage refinance?
Well, it depends. So if it is an existing mortgage, right, you have security in place for $400,000. We can go back to $400,000 without engaging the attorneys.
Yes.
Right? If it's a case where you want to go past that $400,000, you have to increase the security coverage.
Okay.
So that's where we engage the attorneys to say, well, hey, look, the customer is looking for some more funds. Can you increase what we currently have in terms of security to cover these additional monies?
Okay.
And that's where the legal process comes.
Okay, so in looking at the big picture, as you said, I may not necessarily have all the equity in the property secured. Correct?
Correct.
So you guys will then guide me accordingly to say the answer is a no, but this would be the next step if you wish something above and beyond what we're holding security for.
Correct. So going back to that evaluation again, remember, you could have done something to the property.
Yes.
Well, when you have the mortgage in effect. So the value of the property went up.
Okay.
So the house could have been, just an example, the house could have been valued $500,000 when you came to the bank. Something happened and the value increased to maybe $800,000. You want to borrow $600,000. So the difference that you would have had in security, $400,000, and you wanted $600,000, it gives me $200,000. So that's where the up stamp comes into play.
Okay.
Yeah, because we have enough value in the property. It's still equity. Your equity is not just what you owe the bank, but it's overall the value of the property and that mortgage balance.
So I know you guys think I know everything, right? That whole up stamping thing is something I went through very recently, and just to throw some real numbers out there. So when I purchased my most recent property, the mortgage was all in, along with what the bank lent me for the renovation. The bank lent me $220,000. We had that little phase where we accidentally let down the house, but the point is the house is now valued at more than $220,000. I think it's valued at $450,000. So me and the bank agreed back after that. You know, like we got back together, and all of a sudden I was no longer persona non grata. I could walk through the bank and get invited to things. So now that we have a nice house and we fixed the problem, but there's a big difference between 220 and 450.
Right.
So in securing, I would have shared with you guys that the bank approved a mortgage for a apartment block. As a part of all of that, they up-stamped what I call the Bajan Renovation house. I wanted to access some of the equity in there, and they said, okay. She took out the mortgage for $220,000. She now paid off already about $20-something thousand. The gap between the value of the house, because you see we agree back now, all right? The gap between what is owed and the value of the house, there's now equity. Now the bank needs to own a greater stake in the house because they only own the $220,000 up to this point. So to make sure that they also have coverage for the rest, they up-stamped the mortgage. And all of that I learned in the year of our Lord 2026. And it was not free. Okay, so we're covering some bases. Okay, so we've discussed home equity loans, mortgage refinancing. Who can get one from you? A question that has been asked is, can you get a home equity loan from a lender that your mortgage is not with? How does that work? Can that work?
Well, I'll tell you no.
Okay.
The mortgage would have to be with us at Republic Bank. But good news, we always have our campaigns going in terms of mortgages, so you can just simply switch.
Switching?
Yes.
Okay. Now, I've done it, and it was worth it for me. Are there any incentives for switching? We don't got to get into specifics, but I am pretty sure that switching does not involve me here. Say here, have it. The process of switching, just roughly, if I'm saying that, look, I'm liking what I'm hearing from you guys. I've had my mortgage with another lender for a while. I think I can get more out of my property. When they come to you, what are you going to be asking them for? Right.
So the normal job letter, pay slip, ID, because again, you're new to us.
Yeah.
We will ask you for a current balance of the mortgage, as well as any other obligations that you may have. And persons often wonder why we're asking for those other obligations. It's because we want to do a holistic picture instead of switching the mortgage, we may call it the home equity loan,
Yes.
and do a debt consolidation in the process,
Yes.
where we also take off the mortgage as well as all the other obligations that you have outstanding.
Okay. I'm glad you had just even mentioned that consolidation, and a few things came out of this conversation, even though we were speaking about mortgage refinancing and home equity loans. Our assets can work harder for us.
Yeah,
Correct.
true.
I think that is, if you guys take anything from this conversation, a lot of times we all find ourselves in a pinch where we either need more cash flow to do something, or we just need a little fiscal room. And the home that you are in may be able to provide the solution for that. But as you guys said, it starts with a conversation.
Correct.
Because it is not one size fits all. Throughout my property journey, different products have worked in different seasons. Right now, Kelly got all the things, but you don't require all the things to have a solution. So, parting shots, if anyone has listened to this, and I know a lot of you are now like looking at this house and saying, you got to perform. No, you can perform like Marshall. No. They're thinking about this. Next steps. Final word to you.
Well, the final word would be that have the conversation. It is important.
Okay.
I mean, yes, you might have equity. You don't need to use it. That's a misconception, you know, but it is always good to have the conversation. It might not be a situation where you would need to do anything right now, but you might have a child who is in secondary school soon, probably going to college or university. So it's just good to know ahead of time what you would need to do for whatever the situation may be. So it is always best to just give us a call and just have that initial conversation so you know what you have to do going forward.
I like that what you just said. You may not even need it right now. And I think sometimes when people find themselves in a pinch to do these bigger transactions, you need a little bit of a runway. You may need 2 to 3 months. So get prepared from now. Know what your options are so you can make decisions. Is there anything from you?
Well, I want to say, echoing Nikita, you plan. And to the younger ones out there, let's put it that way.
He met me. Go ahead.
It is always best to engage a financial institution right out the bat.
Yes.
So that you can get some guidance, not just with mortgages in the whole, but life overall in terms of handling your finances.
I'm so glad you said that. I think a lot of people think that financial tools and services are for certain types of people, or when you have a certain amount of money. Much like when people tell you the time to save for retirement, no, the time when you get a job is the time to engage your banker. And engage your banker, because they can guide you along the way, because you don't know what to ask sometimes. I would have never asked for a home equity loan or a mortgage refinance unless somebody said, look, but they cannot help you if they do not know what you are doing.
It's true.
Okay.
And outside of the younger ones, those who are self-employed, right? Just to debunk the myth, we do help a lot of self-employed persons.
Yes.
I think the challenge though may be the documentation. So now would be the time to start putting those documents in place as well, and that is your tax assessments, your financial statements, or your management accounts. Right? Once you have those, at least we can start to have an analysis on what your income is, and we can go from there.
Again, I'm glad you said that, because outside of people thinking that you need to have a lot of money or a lot of things to engage the banks, at least my experience has been, you guys have been very accommodating through, I call this self-employment period. They quarreled with me a lot behind the scenes, but you know, there's a family environment, there's a family show, so I won't tell you all that went on behind the scenes. But as you said, the bank can tell you what you will need before you need to present it, so you can get yourself ready. So I hope you guys are getting yourself ready. We covered quite a bit today. It was quite a mouthful. I trust you found it informative. We discussed mortgage refinancing, home equity loans, switching, financial planning, not looking down your house by accident, but more importantly, being able to make decisions with clarity and confidence and engaging your banker. I'm Kelly Johnley, and this is Bajan Renovation.